So, a very good evening to everyone here. I'm Ikai from FSM Global. Welcome to this evening webinar, Stay the Course, What to Hold, What to Drop, and How to Stay Disciplined. So we are just reaching the end of April. Yeah, it seems like a long time has passed, from the gold surge at the end of the last year, to the conflict in the Middle East at the beginning of the year, to the oil shock. Everything just seemed to stack up. So amid this volatile background, all the more we need to stay calm and take a disciplined approach to investing. So we should not be driven by our emotions and instead take this opportunity to review and reposition our portfolio for the journey ahead. So this evening, I'm privileged to have Yu Wei Ren, Senior Portfolio Manager of Research and Portfolio Management Team of IFA Singapore with me. He'll be sharing tips on how to reposition our portfolio, drawing on data from decades of market history. So I have with me too, Tan De Jun, Portfolio Manager, Research and Portfolio Management Team of IFA Singapore, who will share with us, four crucial updates to our mass portfolio to be in the lead on the recovery ahead. So if you have any questions along the way, feel free to put into the Q&A box, and then the presenters will get to them at the end of the presentations. So due to time constraint, I have to apologize first, if you're unable to answer all the questions that you have, and I seek your understanding on this. Before further ado, let me pass over to Wei Ren to start the webinar going. Wei Ren,
Okay,
please.
thanks, Ikai. And good evening, everyone. My name is Wei Ren. I'm a senior portfolio manager at iFast. And I know a lot of you have been watching the news and are trying to figure out what to actually do in this current market environment. So this is going to be the key focus of my sharing today. I'm going to share with everyone where we think the investment opportunities are, what to hold, and some of the areas that we think you should be avoiding. Now, let me first start with a bit of perspective on the current Middle East crisis. There has been some encouraging developments over the past few weeks. There has been a ceasefire, there has been active diplomacy, but the situation is still quite fluid. But what we can say with confidence right now is that the Strait of Hormuz remains closed. Oil prices have been going up over the past week to above $100 a barrel. And the head of the IEA, he has also said last week that the world is facing the biggest energy security threat in history. So this feels alarming. And I think for a lot of investors, this probably feels, different. It feels unprecedented. But if you look back at past crises, the historical data actually tells us, a very different story. And this is what the history tells us. It tells us that this is actually not the first time that the world has been through an oil crisis. Now take a look at this table. And what you're seeing here is the history of major oil price shocks going all the way back to 1973. So in 1973, oil prices went up by 300%. Okay, 300%. This is not a typo. Okay, it's 300%. At its peak, oil prices were at $12 a barrel. Now, here's the thing. Okay, $12 in 1973 is very different from $12 in 2026. So you have to adjust this number for inflation. So if you adjust $12 for inflation, it is equivalent to about $80 per barrel in today's money. Okay, so that was what happened in 1973. Now, in 1979, oil prices increased by 167% to $40 a barrel. So in today's money, $40 is equivalent to $159 a barrel. Okay, and if we look down the table, in 2008, at the peak of the commodity boom, oil prices hit $147 per barrel. And if you adjust this number for inflation, okay, it's actually $223 per barrel. So the world has actually experienced oil prices that are way higher than today. We have survived $223 a barrel oil. We have survived a 300% increase in oil prices. Each time, okay, the pain was real. Okay, there was real economic pain globally. But each time we adjusted, we recovered, and then we moved on. And we don't even need oil prices to come down in order for markets to do well. Look at what has happened over the past few weeks. The Strait of Hormuz is still closed. Oil prices are back up above $100 a barrel. There is no peace deal. But yet, look at what's happening to markets. Markets across the world have rebounded very strongly. So I think the history is very clear. Markets will eventually recover from this crisis, and they do not actually need the crisis to end before the recovery happens. And this recovery that we're seeing in markets right now is very clear, especially in Asia. Okay, Asia was supposed to suffer. Okay, if you can recall at the start of the conflict, what did most people say? They said that Asia would be the hardest hit because Asia imports most of its energy. So higher oil prices means higher cost, higher inflation, slower growth. Okay, which is logical if you think about it. But look at the reality. Look at these numbers that you're seeing in the screen. These are data that has been released over the past few weeks. Okay, Singapore exports up 15.3% in March. Semiconductor exports up 114%. And then you look at Korea, exports up 48.3% in March. So this was a record high. And I want to emphasize that this data was in March. Korea achieved record high exports in March. This was the time when the worst of the crisis took place. This was the time when the Strait of Hormuz was effectively closed. And this momentum, this export momentum that you're seeing in Korea, it has actually continued into April. So during the first 10 days of April, what we also saw was that Korea's exports were up by another 36.7%. Semiconductor exports up 152%. And then there is China. First quarter GDP beat market forecast. And I think what is also very interesting is that the clean energy exports were up very strongly. So Asia was supposed to suffer during this crisis, but what actually happened is that it was actually pretty resilient throughout the entire crisis. So again, I emphasize, okay, history tells us that markets will eventually recover from this crisis, and they do not need they do not need Donald Trump to, officially announce that the war is over before they start to recover. Okay, so this is what history tells us. But there is also another thing that history also tells us. History also tells us that the world after an oil crisis is not always the same as the world before the crisis. And at this time round, it's also the same. Because even if the war ends today, the world is not going to, simply go back to its original state before the war. Some things have changed permanently. So what are some of things that have changed? There are two things that have changed. Okay, the first is the physical supply of energy. So even if the war ends today, okay, it will take time for oil markets to normalize because production takes time to restart. Ships will not return to the Strait of Hormuz until it is safe to do so. Refineries, they will also need time to restart. And if you add everything up, we're looking at least a few more months of high oil prices. And that is before you even consider the damage that has already been done to the energy facilities. So this will take time to repair as well. And the damage that has been sustained by Qatar's LNG facilities. 17% of its capacity took direct damage. And this takes about 3 to 5 years to repair. Okay, 3 to 5 years, not 3 to 5 months. Okay, 3 to 5 years of lost LNG supply over the next few years. So a peace deal that is being signed today, it is not going to reverse all of this damage. So this damage is sort of permanent, at least in the short term. So energy prices will not simply just revert to pre-war levels, even if there is a peace deal that is being signed today. Okay, so why is high energy prices such a big deal? Now, it is a big deal because energy prices feed into inflation. And history is also very clear on this. Every time when energy inflation goes above 25%, okay, there are three times that this happened in 1974, 1980, and 2022. So during each of these three episodes, interest rates all went up. And right now, oil prices are already 50%, more than 50% above pre-war levels. So if this continues and if inflation keeps rising, then what this means for all of us is the rate hikes that we are supposed to see at the start of the year, okay, it is not going to materialize. In fact, I think all of us, we should be prepared for rate hikes to happen instead. So this is the structural reality that we are expecting to happen, even if the war ends today. It does have implications for how we do our portfolio allocation, but it doesn't mean that there is nothing to buy in this current market environment. In fact, I think there's still lots of opportunities, even if there is inflation, even if there are rate hikes. And let me share with everyone today some of the markets that we are very positive on. Now, the first markets that we're positive on, South Korea and Taiwan. Now, at the start of the war, there was actually a very sharp sell-off in these two markets because semiconductors are the key industries for these two economies. And semiconductors, as we all know, it is energy intensive. But the main reason why we like South Korea and Taiwan is not because they are immune to the crisis. They are not. Okay, they are also being hurt in the short term by high energy prices because Korea and Taiwan they are paying a huge premium to secure their energy supplies. The reason why we like them is because they are irreplaceable. Samsung and SK Hynix they control approximately 80% of the global high bandwidth memory production. And then there's TSMC, which manufactures about 90% of the world's most advanced semiconductors. So there is no other alternative. And this is why companies like Samsung, SK Hynix, and TSMC, they have such strong pricing power. The war is not going to change that. And on top of that, if you look at some of the actual data that has been released over the past few weeks, which I've shown you, in my previous slide, what all the data show is that Korea and Taiwan, they are still relatively resilient throughout the crisis. Okay, if you take a look at Samsung's earnings, okay, it's quarter one operating profit up 755%. SK Hynix operating profit up 406%. So both are record highs. And again, Korea's total exports, it was also at a record high. And this was the time when the worst of the crisis took place and when the Strait of Hormuz was closed. So Korea achieved this kind of economic performance under such conditions. And if you take a look at Taiwan, okay, TSMC's Q1 net profit up 58%. So this is the fourth consecutive quarterly record, and its full year revenue growth, it has been revised upwards to above 30%. And at the bottom of this slide, what you see are also some other data points, which are not related to Korea or Taiwan, but these data points actually come from different parts of the global semiconductor supply chain. And they all point to one thing. They point to the fact that semiconductor demand is still very strong. Okay, Singapore semiconductor exports up nearly 114%. Intel reported better than expected earnings. And Intel is actually a struggling company. If even Intel can deliver strong results, then this also means that the global semiconductor demand is strong enough and broad-based to benefit even the weaker players. So this is why we are very positive on Korea and Taiwan because they are also a way to get exposure to the AI story that we have seen in recent years. And they are also much cheaper compared to the US semiconductor companies. So one way to get exposure to AI at a much cheaper valuations is to go for some of these Asian semiconductor companies like SK Hynix, Samsung, TSMC. Now let's talk about some markets that are closer to home. Singapore and Malaysia. These two markets are also something that we are also positive on. So both of these countries, they are structural beneficiaries of the Gulf capital that is now leaving the Middle East. Now, over the past decade, what has happened to global capital is that the Middle East, they have built a very vibrant wealth management center. So countries like Saudi Arabia, the UAE, they have cut their taxes, they have introduced policies to attract family offices, and they have also positioned themselves as the place, as a haven for global capital. And it was successful because there was stability. But now the stability is gone. The Middle East is now a war zone. The super rich, they are now looking to leave. And when they do that, their wealth will also follow. And where do these super rich investors go? One of the places that they will definitely consider is Singapore. Okay, Singapore is the natural destination for global capital because we have political stability, we have the rule of law, we also have a strong currency, and we also have a very sophisticated financial infrastructure. So the key beneficiaries of this trend, they will definitely be our local banks. Okay, DBS, OCBC, and UOB. So they are going to be earning a lot more wealth management fees. And before the war, Singapore was already in the midst of a market revival because of the EQDP. After the war, Singapore will still have a market revival and it will also benefit from Gulf capital inflows. Malaysia will also be able to capture some of these flows. And you must be wondering, why is Malaysia able to benefit? Malaysia is able to benefit because it has certain things that Singapore doesn't have. Okay, Malaysia has deep Islamic capital markets. Okay, it has a Sharia compliant wealth infrastructure. And for some of the Gulf families who are looking for a Muslim majority environment that also has sophisticated financial services, that Malaysia is actually the perfect place for them. So if you want to invest in ASEAN, then I think the two markets that you really should be looking at right now are Singapore and Malaysia. Okay, next, China. I think China is one of the most interesting story in this crisis for a couple of reasons. So firstly, I think China is one of the most insulated economy throughout this crisis. It has over 100 days of reserves. It also has a lot of coal, renewables, nuclear energy, and only about a third of its crude oil comes from the Middle East. So they are exposed to the crisis, but at this point, I think it's very manageable for them. Now, the second reason why we are so positive on China is because China is the dominant supplier of energy transition equipment, like solar panels, your lithium batteries, and your electric vehicles. Every government that is watching this Middle East crisis, they are all going to be asking themselves the same questions. How do we make sure that this doesn't happen to us again? How do we make sure that the next time that Iran decides to close the Strait of Hormuz, how do we ensure that we have enough energy for ourselves? The answer to that question, I believe that's the conclusion that many governments have already come to. The answer is renewable energy. And China makes nearly all of the hardware and equipment that powers renewable energy. So this is a structural demand tailwind that's going to run for years ahead. And there is a third reason why we like China. Okay, it's because of AI. AI is fundamentally an energy intensive business because you need a lot of power to run your data centers and to train your AI models. And energy is expensive right now because of the Middle East crisis. And that's where China comes in because China's electricity is significantly cheaper. And it's cheap because of all the massive investment that China has made in renewable energy over the years. And also the fact that China, they also have a lot of domestic coal as well. So at the time when energy costs everywhere else is rising, China actually has a huge cost advantage in the global AI race. Japan is also very similar to China, and it's also one of the markets that we like. We think that Japan is actually very well prepared for this energy crisis. So on paper, Japan actually looks very vulnerable because Japan imports about 90% of its energy. But in actual fact, Japan has a lot of oil reserves. 250 days of, of oil reserves. And Japan also has nuclear power plants that they can switch back on. The reason why they initially switched off these nuclear plants in the first place is because of the Fukushima crisis. Back then, I think most people were against it because they have concerns over the safety of nuclear energy. But I think over the years, public opinion has changed because of the conflict in Ukraine, and now there's the war in the Middle East. So these developments have made Japan realize the importance of energy security. And Japan has also been proactively diversifying its energy sources over the years. So if you look at its LNG imports, its share of LNG imports from Qatar has actually fallen from 18% in that is in 2012 to about 4% today. So Japan has already done the energy diversification that every other country is now starting to do. So Japan will be able to recover from this crisis. But I think for us, why we like Japan is because of the structural thesis that is, supporting the Japanese equity market. So this structural investment case that we're looking at is about the corporate reforms. The corporate reforms in Japan that are forcing companies to address their chronic undervaluation, to improve their shareholder returns and to drive up their overall profitability. So it's about the corporate reforms. It is also about the economic transformation from deflation to inflation. So Japan has an entire generation of workers that have not seen a single wage increase in years. Okay, but over the past 3 years, what has happened is that wages have been rising, and what has also happened is that monetary policy normalization, it is still intact. So Japan's economy is transforming for the better. So these are decade-long, multi-year structural changes that do not reverse simply because of the war in the Middle East. Okay, so just very quickly talking I just wanted to take you through some of our recommended products for some of the Asian markets that I have just highlighted. So for Japan, our recommended fund is actually the one by Eastspring. For Singapore, the Line Global Singapore Trust, which is one of the EQDP funds that have small to mid cap exposure. For Malaysia, you can consider either the Aberdeen Malaysia Equity or the iShares MSCI Malaysia ETF. For China, Line Global China Growth. Now, if you want a passive option, I think that would be the iShares Hang Seng Tech ETF. For Korea and Taiwan, we actually recommend the Global X Asia Semiconductor ETF for you to capture the Asia semiconductor story. The top holdings of this ETF are Samsung, SK Hynix, and TSMC. So if you need to just buy one ETF to capture these three companies that I've talked about today, then I think this Global X Asia Semiconductor ETF is very suitable because it gives you exposure to all these companies. Now, the markets that you see on this screen right here, each one of them has a structural reason to do well, regardless of when or how the conflict eventually resolves. But if you want broad regional diversification instead of just betting on individual markets, then you can also consider buying an Asia ex Japan fund. We have some recommendations for that. I think the Asia Pacific Equity as well as the MNG Asian Fund. For a passive solution, I think that would be the iShares Asia ex Japan ETF. So these are all good options for you to consider. So I've just shared with everyone, some of the markets that we think you should be buying. So of course, we also need to talk about some of the assets and markets that we think you shouldn't be buying at this point. Okay. So the first asset that I want to talk about is gold. Okay. Gold fell close to 12% during this war. Okay, so when we have this kind of a crisis like the US-Iran war, gold is supposed to do well. But you take a look at what happened, okay? S&P 500 during this period, it has during the period from 28th of February to 7th of April, okay, just right before the ceasefire happened, S&P 500 fell 3.7%. Nasdaq was down 2.8%. Brent crude up more than 51%. But look at gold. Gold actually fell even more compared to US equities. There are a few reasons why gold, has delivered such a poor performance during this period. Three reasons. So firstly, bond yields have been rising. So gold is an asset that pays you no income. So when bond yields rise, gold becomes relatively less attractive. And secondly, there has also been record outflows from gold ETFs. Okay, 12 billion US dollars of outflows in March alone. So if you can recall, in 2025, everyone was rushing to buy gold. Even your TikTok influencers, they are all recommending gold as a very good investment. So what this triggered was a rush into gold by many different investors. And these are mostly investors who just wanted to chase the gold rally. So when prices started to drop, when there was a crisis, everyone started to rush for the exits. Everyone started to sell gold. Okay, and that was what part of the reason that explained the poor performance of gold during this period. And some people of course argue that central banks have been buying gold, right? So they will probably provide a support for gold prices. I'm sorry to break this news to you, but central banks have actually been selling gold in the month of March. So all these reasons contributed to the decline in gold during the Middle East crisis. Okay, but I have to acknowledge that gold is good at one thing. Okay, it is good at diversification. Okay, because gold moves differently from everything else over the long run. So if you look at the correlation of gold to US equities, okay, if you compare the degree of the movement of gold relative to US equities since 1971, this correlation is essentially zero, which means that when stock markets fall, gold doesn't necessarily fall along with it. So this is a real portfolio benefit. But of course, when you look at the recent 5-year correlation, so this correlation with US equities has actually gone up, which means that gold has lost a bit of its diversification power over the years. It is still useful, but it's less so compared to the past. So what's our recommendation for gold? So if you are buying gold for portfolio diversification, I think that's a sound reason to hold gold inside your portfolio. Just that we think that it must be a small allocation of anything anywhere between 0 to 10%. And I want to emphasize that gold is for diversification. Okay, it is not meant to be for capital protection. It is not meant to be a crisis hedge. Okay, so if you're looking for something that can preserve its value when markets are volatile, I think there are better options out there compared to gold. So I think short duration bonds, money market funds, I think these are the better options if you want if you want something that truly protects your portfolio in the event of a market crisis. Okay, so these options here, I think money market funds and short duration bonds, they are good options because they pay you an income. And when they mature, they reinvest at whatever the new interest rate is. So in a rising interest rate environment, this is actually an advantage. It's not a disadvantage. Okay, it gives you income and it also gives you a much lower risk as well. Okay, so the products at the bottom of the slide, these are some of our recommendations. So if you want gold exposure, you can consider the GLDM or the Line Global Physical Gold ETF. For short duration bonds, you can consider the Amover Short-Term Bond Fund, United SGD, or the iFast SGD Enhanced Liquidity. Now, let us talk a bit about US, because I believe that's likely a market that most of us have exposure to inside our portfolios. Now, our view of the US is actually an underweight position. And I want to be very clear about what that actually means. Okay, so we're not saying that US companies are bad. Okay, in fact, US companies are pretty good. Okay, their earnings are good. They have the earnings momentum. So we're not saying that you should sell all of your US stocks. Okay, what we are saying is that on a relative basis, we feel that Asia is actually more attractive because you can get the same kind of growth in Asia at a much cheaper valuation. So, and if you look at the valuations of the S&P 500, the US equity market is actually not cheap. The S&P 500 is currently trading at nearly 22 times its forward earnings, and our fair PE estimate for the US market is actually 20 times. And this expensive valuation is also happening at a time when energy prices are affecting your margins. Tariffs are adding to costs, and labor market is softening in the US. And there's also the fact that the Fed, they cannot cut rates at this time because of inflation. So at the start of the year, Fed rate cuts was supposed to be a tailwind for equity markets, but that tailwind has now been removed. But there is one area of the US equity market that we think is still attractive, and that is the internet sector and your technology companies. And the reason for that is very simple. Okay, we like them because they are actually quite insulated from any domestic slowdown in the economy because more than half of their revenues actually come from outside the US. And their earnings momentum at this point is still very strong. The most interesting thing about the internet companies right now is that their earnings estimates have actually been revised upwards, even though their share prices have been falling. So this means that the markets have punished the stocks, even though their fundamentals didn't get worse. Okay, so this is an indication that the sell-off in some of these tech firms that we are seeing on a year-to-date basis, this sell-off has probably been overdone. So our recommended position for the US is actually to underweight the broad US market, but still retain exposure to the internet and also the technology names in US. And that's where we think is the most attractive sector in the US right now. So our preferred product for exposure to internet companies is actually the Invesco Nasdaq Internet ETF. So this is a passive solution. If you prefer an active approach, you can also consider the Fidelity or the Eastspring Technology Funds. So for broad US exposure, we actually recommend a quality ETF, such as the JP Morgan US Quality Factor ETF, which gives you the kind of exposure to companies that have strong balance sheets and earning stability. So this is the kind of attributes that you want in this kind of an uncertain environment. Okay, a few more things that I believe you should leave alone. So these are basically your sectors that are sensitive to rising interest rates. So one of them is, of course, your S-REITs. I know Singaporeans love S-REITs, and many of you who are listening to this webinar right now, you probably have REITs inside your portfolios because dividends are attractive, it's a steady stream of income. But in a rising interest rate environment, S-REITs will be negatively affected. Okay, you can think of it this way. When interest rates rise, investors can now get better returns from bonds. Okay, and bonds, as we all know, it is something safe. It is also something that pays you a fixed income. So if you are going to buy a REIT instead, you need this REIT to pay you a better return. Otherwise, why do you even take the extra risk? Because REITs, they do have a bit of equity risk. So you need the REIT to pay you a better return. And the only way for you to get a better return from the REIT is for the price to come down. So the rental income, okay, the REIT can be, the REIT can have very strong fundamentals. Okay, the rental income hasn't changed, but the price has to fall in order to make the yield attractive again. So if you move from equities into REITs, thinking that, oh, maybe the stream of income can help to reduce my portfolio risk, then you may have actually unintentionally increase your portfolio risk instead, because as REITs will be negatively affected in a rising interest rate environment. And the other area to avoid is your long duration bonds. So bonds, they give you income, but they also give you capital loss in a rising interest rate environment, especially your long duration bonds. So for fixed income investors, what we recommend is short duration bonds because they give you income. They also have shorter maturities. So if they have shorter maturities, what happens is that when they mature at about 1 to 3 years time, the proceeds can be reinvested into existing bonds that carry higher yields. So you're not locked into the longer term duration that is being offered by long duration bonds. So you benefit from higher yields as the interest rate environment changes. So short duration is the right exposure for fixed income investors. Okay, so let me just bring everything together. So there are 5 things that I'd like you to take away today. So firstly, I talked about gold. I think gold is a diversifier. It is not a safe haven. So if you need protection for your portfolio, if you want something that can reliably preserve their value, I think money market funds and short duration bonds are better options. Okay. Number two, add to Asia. Asia was supposed to suffer during the war, but it didn't. And the investment thesis for Asia is stronger today than it was before the war. So continue buying and take advantage of any pullbacks to add to your Asia exposure. Number three, reduce the US and redeploy into Asia. So for the US, like I said, we're not telling you to sell every single part of your US exposure. Okay. As underweight means, you own less than what you usually own inside your portfolios. You don't have to sell everything. Okay. On a relative basis, Asia is more attractive. So if you want to redeploy some of the US exposure, one of the areas that you want to consider is Asia. And within the US, okay, within your current US exposure, I think one of the areas that you can consider buying into is internet companies. Okay, number four, reduce your rate sensitive exposure. So I talked about REITs, I talked about long duration bonds. So these will be affected in a rising interest rate environment. I think last but not least, this is something that I didn't cover in my sharing today, but one of the things that we've been telling our clients is not to time the market. So Asia is attractive, but you don't really have to go all in immediately. You don't have to own everything by tomorrow. Okay, so one thing that you can consider is to slowly, build your exposure into Asia by using an RSP, okay, your regular savings plan. This is a systematic and a very disciplined way of investing, and this is something that you can consider, for your Asia exposure, especially if you're interested in some of, the recommended products I've talked about just now. Okay, so with that, I end my sharing, and right now I'd just like to hand the time over to my colleague Dejun, who will give us an update on the performance of our MAPS portfolios. Yeah, Dejun, over to you.
Okay, so thank you, Aaron. Just give me a moment. Let me share my screen. Okay, so yeah, good evening, everyone, and welcome again to tonight's webinar. So my name is Jun, and I'm also part of the research team at iFast. And for the second half of this presentation, I'll be sharing an update on our MAPS portfolios and how it has done over the first quarter slash year-to-date period. Yeah, so for those of you who are new to our webinars, just let me take a quick minute to introduce MAPS before we dive into the actual market update. So MAPS is our online managed portfolio solution, which is designed to make investing simple and convenient. So rather than worrying about what to buy, when to buy, when to rebalance, or how markets are moving, MAPS will handle it all for you. From building your portfolio to selecting the right investments and monitoring markets and rebalancing, we will take care of all the details so that you can invest with confidence and peace of mind. So simply put, MAPS gives you a hands-free way for you to grow your wealth. And to make this possible, we have a dedicated team of over 10 portfolio managers and analysts in Singapore who closely monitor markets and bring their best ideas into the portfolio. So they are also supported by a wider regional network across Malaysia, Hong Kong, and even China, providing additional insights should it be required. So this is not a new offering. It is actually a proven investment solution that we have been running for close to 10 years already, since 2016 through different market cycles. So why should you choose MAPS? I would say there are three things I'd like to highlight. So first of all, it is the professional discretionary management. So with MAPS, we're not just giving you a model portfolio and leaving you to do whatever you want with it. So as a managed portfolio solution, our experienced team handles the day-to-day investment decisions from you. Like what I said just now, from portfolio construction to product selection to rebalancing, we will take care of everything. And rest assured, even though this is a discretionary portfolio, every action that we take is aligned with the investment objectives and also the risk profile of each portfolio. So the second thing you should take note about MAPS is diversification. So our portfolios, they are not only diversified across markets and sectors, but also across products. So we combine unit trusts and ETFs to strike the right balance between passive and active strategies. So UTs on one hand, they can uncover hidden opportunities through active management, while ETFs, they can provide a broad market exposure at a low cost. And putting them together inside our portfolios, this should allow investors to enjoy the best of both worlds. And as for our product selection, we rely heavily on our focus list, which is basically a curated collection of top-tier unit trusts and ETFs that have been carefully chosen by our research team. So the third reason is accessibility. And by this, I mean two things. So the first is that you can start with as little as $500 for a lump sum investment, and your monthly RSP contributions, they can start at just $100. So MAPS also offers both income and growth portfolios, each with 5 different risk profiles ranging from conservative to aggressive. So there is something for everyone. Our fees are also quite competitive, starting from as low as 0.0875% per quarter. So overall, MAPS is an investment solution that provides a hands-free approach for you to grow your wealth, and it is ideal for investors who are seeking convenience without the stress of daily monitoring. So all you need to do is really to choose which portfolio you like, and we will do everything else for you. It is really that simple. So underpinning everything we do is the single investment philosophy that we have, and that is to maximize risk-adjusted returns over the long term through fundamental investing. So what does this mean in practice? So first of all, it's proper diversification. So to us, successful investing is about building a resilient portfolio that can weather different market cycles. So we spread our investments across various asset classes, geographies, and product types so as to ensure that no single event or market move will define your results. Second is a focus on fundamentals and valuations. So over here at iFast, we are all long-term fundamental investors. This means that we don't chase short-term trends or try to predict every market swing. Instead, we concentrate on high-quality assets with strong fundamentals purchased at sensible valuations. So by focusing on fundamentals such as your earnings growth, valuations, and other structural factors, we aim to deliver sustainable returns over time, making sure that investments that are compelling today and are also resilient for the long term. Last but not least, we are long-term investors. We make deliberate conviction-backed decisions and give them time to play out. So markets fluctuate in the short term, but investing, for us, it is a marathon. It is not a sprint. Now, with that out of the way, let's move on to what actually happened to markets in the first quarter and year-to-date as of late April. So the big story here is that equities in Asia and semiconductors. So as you can see from this chart, South Korea led all major markets with a gain of 14.8% in the first quarter and an outstanding gain of nearly 50% year to date, driven almost entirely by AI-related demand for memory chips, particularly from companies like SK Hynix and Samsung. So Taiwan is not too far behind at 7.7% for the first quarter and 33.2% year to date. And if we look further, the global semiconductor index has actually returned 6.6% in the first quarter and up to 39.6% year to date. So all these are remarkable numbers. Moving on, Japan has also delivered solid returns, up just 0.7% in the first quarter, but 16.5% year to date. Asia ex-Japan performed well also, returning negative 1.1% in the first quarter, but it recovered strongly to 14.4% year to date. So same story here with emerging markets, which bounced back to 14.3% year to date after a rather soft first quarter. But on the other side of the ledger, if you look at developed markets like the US, for instance, they have underperformed. So as you can see from the chart over here, US equities returned negative 4.3% in the first quarter, and they were up by 4.2% year to date, reflecting the drag from elevated valuations, geopolitical uncertainty, and the impact of the US-Iran conflict on energy prices and inflation expectations. So Europe was also soft at negative 2.4% for the first quarter. So the digital economy also had a very rough quarter at negative 16.9%, though it has partially recovered to minus 10% year to date. So after the war broke out, we have also put up an update telling people to not panic, as the best returns are often made when markets feel the worst. I hope you heeded our advice, because for those of you who sold out and missed out, those of you who sold out would have missed out on all the gains that were accumulated in April. So a couple of key points we made in the article is that first, geopolitical crises, they tend to have little lasting impact on share prices. And second, the fundamentals underpinning the equity markets remain intact, especially the markets that we are positive on. So unfortunately, I don't have time to go through every single point, one of these points in detail, but if you would like to read the full article, it is on our website. Turning to fixed income, and this is an important part of the portfolios also, especially for our more conservative investors. So the global bond market had a challenging first quarter, falling 1.1%. So rising yields driven by persistent inflation fears following the disruption in the Strait of Hormuz weighed on longer duration bonds. However, the picture has improved slightly year to date, with the global aggregate bond index recovering to a positive 0.3% as of late April. So the stronger performers within the fixed income segment were the higher yielding and shorter duration segments. So Asia high yield stood out with a 2% gain year to date, while US high yield returns 1.3%. So these categories, they largely benefited from their relatively lower sensitivity to interest rate movements and attractive income levels. Emerging market bonds had a tougher time, falling 1.6% in the first quarter, although they have somewhat recovered. So the key message here is that for our fixed income positioning, which has been skewed towards shorter duration and Singapore-centric bonds, has helped to cushion the portfolio returns from the worst of the rate volatility. And you'll see how we're positioned later in the presentation as I go through the changes to our portfolios. Now, with that out of the way, let's take a look at how our portfolios have fared in the first quarter. So in the first quarter of 2026, you can see that all 5 risk profiles saw slight negative returns, ranging from negative 0.7% for the balanced and aggressive portfolios to negative 0.8% for the rest of the portfolios. So that's a modest drawdown given what a volatile quarter globally it has been. The US-Iran conflict, the oil price shock, the rate uncertainty, all these things weighed on markets in the early part of the year. But if you look at the year-to-date picture, it tells you a much more positive story. So as markets recovered and our Asia and semiconductor positions rallied, returns moved firmly positive. You can see that the aggressive portfolio has returned as much as 8.2%, moderately aggressive 6.4%, balanced 4.6%, moderately conservative 2.8%, and last but not least, our conservative portfolio 1%. So by the way, the returns that we are showing here and anywhere else in this presentation, they are all net of fees. Okay, so this also reflects the actual returns you receive as an investor in our MAPS portfolios. And I think that the results over here has also shown the benefit of staying invested through volatility rather than reacting to short-term noise, which is one of the core principles that sit at the heart of our investment philosophy. So it is also worth zooming out and taking a look at things from a longer term picture. So the since inception chart over here shows you that despite multiple market cycles, including the COVID crash, the rate shock in 2022, and of course all the geopolitical tensions, turbulence this year, our portfolios have continued to compound positively over time. So this is the power of disciplined, diversified long-term investing. So at present, if you can see over here, all our portfolios except the conservative portfolio have already surpassed their previous all-time highs, with the aggressive portfolio close to doubling returns since inception. So we show this slide as a reminder for you to not focus on short-term volatility, but rather to remind you that the strategy is actually designed to work over full market cycles. So short-term dips, like what we've seen in the first quarter of this year, these things are all part of the process. And going forward, we will strive to deliver even better returns for our investors. Now, just let me talk about some of the key decisions that drove our outperformance in the first quarter of this year, as well as year to date. So the most impactful was our overweight to Japan and Asia ex Japan. So Asia ex Japan returned 14.5% year to date, while Japan returned 16.5% year to date. So just to clarify, our Asia ex Japan overweight was only implemented earlier this month. So both these markets, they significantly beat the MSCI equities gain of around 5.4%. So being overweight these markets was one of the biggest contributor to relative returns for our portfolios. Moving on, for our UX exposure, we also stayed selective there. So rather than holding broad market exposure, which lost ground, we stayed underweight the S&P 500 and maintained an overweight in the digital economy sleeve. So if you look at our digital economy sleeve, some of our funds there, such as the VanEck Semiconductor ETF, they delivered returns of close to 40% year to date, while the S&P 500 ETS has only delivered returns of around 4.1, 4.2% year to date. And on top of that, the newly introduced Global X Asia Semiconductor ETF, which I will discuss in greater detail later on, has gained an impressive 32% in its first month. So on fund selection, the Dimensional European Value Fund has returned 7.8% year to date, also beating the MSCI Equity and comfortably ahead of the Stock 600's 3.4% return. Last but not least, on the fixed income side, our overweight to shorter duration bonds has paid off once again, as bond yields rose in the wake of the US-Iran war. Staying short helped to cushion the blow. So our fixed income funds mostly outperformed the global aggregate return of 0.3% year to date. Now, let's talk about April's rebalancing, what changed and why. So in the month of April, we actually made 3 sets of changes. So the first, we adjusted our fixed income exposure, increasing short duration bonds while reducing global bonds. The second, we adjusted our equity exposure, reducing US equity and increasing Asia ex-Japan equity. And last but not least, we also made a couple of changes to our digital economy and Japan fund sleeves. And I'll walk through each of these changes in detail over the next few slides. Now, so starting with fixed income. So we increased our short duration bond exposure by 2.5%, and that is taken from our global bond exposure. So this has brought the overall portfolio duration down to from approximately 3.8 years to about 3.6 years, which is a more defensive posture that limits our exposure to further interest rate volatility, while still enabling our portfolios to capture attractive income at the short end of the yield curve. So the rationale, I think Wei Ren has explained it pretty well already, so I won't dive into details, but basically the prolonged disruption in the Strait of Hormuz has actually pushed energy prices and inflation expectations meaningfully higher. So expectations for further Fed rate cuts have also been pushed out to 2027, as you can see from the dot plot over here. And some other central banks have even signaled the potential for rate hikes. So all in all, in this environment, longer duration bonds, they carry more risk than they initially appear. Shorter duration bonds, they give us better protection against future rate rises while still capturing attractive income yields on the short end. So most importantly, we haven't abandoned our overweight to global bonds entirely. We still hold global bonds at an overweight of 25% versus a neutral weight of 20%. And the longer term view is we think that if once the oil price subsides, the longer term direction for interest rates could likely be lower, and we would like to maintain some exposure to this while managing some of the near-term duration risk. So moving on to our second change. So in equities, we actually reduced our US allocation by 2.5% to 32.5%, which is now meaningfully underweight versus a neutral allocation of 40%. And we have taken that 2.5% and we put it into Asia ex Japan, raising it from 10% to 12.5%, moving it from neutral to overweight. So the reasoning is that the S&P 500's forward PE currently sits at close to 22 times as of mid-April, which is above its long-term average. While US corporate earnings, they remain resilient, we think that the valuations for the valuations for the S&P index are pretty elevated, which leaves little room for further upside and also increases the magnitude of potential drawdowns should earnings disappoint. But at the same time, Asia ex Japan, they continue to trade at trade at a more meaningful discount to developed markets, even as the region's earning outlook continues to strengthen. And based on our own analysis, we do expect Asia ex Japan equities to see their earnings grow by 30% in 2026, and that is largely driven by the AI-led capex cycle flowing through North Asia, particularly in markets like Taiwan and South Korea. So all in all, valuations for Asian markets, which are currently in the mid double-digit range in terms of PE ratios, they are more relative compared to US equities, which is one of the fundamental reasons why we decided to further underweight US equities and overweight Asia ex Japan. So the final change that we made was within the digital economy sleeve. So over here, we actually removed the Invesco Nasdaq Internet ETF and added in the Global X Asia Semiconductor ETF, ticker code 3119. So I think, as you guys already know, our conviction in the digital economy remains unchanged. And what we're doing here is actually just broadening how we access this theme. So the global semiconductor industry is not purely a US story. I think Asian companies, they also play a critical role across areas like fabrication, memory, and even equipment. However, our digital economy, or rather semicon allocation, has until now been predominantly concentrated in US listed names. So with the inclusion of the 3119 ETF, we are addressing this gap and also gaining a more complete exposure to the entire semiconductor value chain. So in this ETFs, it provides targeted exposure to the region's leading chip makers, including the likes of SK Hynix, Samsung, TSMC, and many of the Japanese equipment manufacturers. All these companies are companies that occupy critical choke points in the AI supply chain, especially in the memory space. So that being said, the core of the digital economy sleeve, it still remains firmly anchored by the VanEck Semiconductor ETF and the Fidelity Global Technology Fund. And yeah, just to touch a little bit on the reasons why we decided to initiate a position in 3119. I think if you look at the latest earnings results from TSMC and SK Hynix, they have really made the case for Asian semiconductors. So in the first quarter of this year, TSMC reported revenue of close to 36 billion US dollars, which is a 40% increase from a year ago and also slightly ahead of its own guidance. But I think the more important thing here is the revenue mix. So if you look at the revenue mix, high performance computing, which is the AI-driven segment, it now accounts for 61% of TSMC's revenue, which is up from 55% a quarter ago. The company itself is also guiding its 2026 capex to the high end of the 52 to 56 billion US dollar range, which is a significant increase from the prior years as it races to build new fabs to meet demand that continues to outpace supply. So to us, this doesn't sound like a company that is facing headwinds, but rather it sounds like a company that cannot keep up with the demand that it is facing. So on the other hand, SK Hynix has also delivered record-breaking quarter one results with revenue reaching 53 trillion Korean won, which is up nearly 200% year over year and marking the company's highest quarterly revenue on record. So the catalyst for SK Hynix is straightforward. It is surging memory prices. So DRAM, which accounts for more than 80% of the company's first quarter revenue, saw prices surge more than 60% quarter on quarter as the AI-driven demand for server memory continues to outpace supply. And over the past 2 to 3 years, SK Hynix has repeatedly said that they have tried to reallocate traditional DRAM capacity towards high bandwidth memory. But even after doing this, capacity remains effectively sold out for the next few years, with the tight supply environment expected to persist at least through 2028 or perhaps even beyond. So given our structural outlook for the digital economy, how the world is becoming increasingly digitalized, how companies are adopting AI and buying AI chips, we expect this sector to continue doing well in the years ahead. Now that sums up all the changes that we have made in the month of April. So before I wrap up, just let me give you a quick snapshot of our current asset allocation so that you have a clear view of how your portfolios are positioned. So first of all, for inter-asset allocation, it remains neutral for now. So that being said, we are actively monitoring market conditions for opportunities to increase our equity exposure because equities, they are really the primary driver of longer term returns. So should there be a more meaningful pullback without any change in the fundamentals, we will use that opportunity to increase our allocation to equities. And within the equity sleeve, we are underweight the broader US market. We are overweight the digital economy, Japan, and Asia ex Japan, while we are neutral on Europe and emerging markets. So on our fixed income side, no significant changes to our fixed income allocation. Even though there's some changes to the percentages, we are still overweight global bonds and shorter duration bonds. We are neutral Asian investment grade bonds and EM bonds, and we remain underweight high yield and Asian high yield bonds. So that concludes the updates for today. So if you have any questions, please feel free to use the Q&A function and we'll be happy to answer them. So yeah, before I end, I'd just like to say that investing, it can be challenging, especially when markets move quickly and you don't have time to closely monitor them. So this is where a managed portfolio solution like MAPS can be valuable, which will provide professional oversight and a disciplined approach to help you keep your investments on track. So let MAPS handle the work so you can focus on enjoying the better things in life. So wishing all of you the best, wishing all of you here all the best in your investing journey, and I hope that all of you here can make lots of money this year. Thank you.
Okay, thanks, Dechun, for sharing on some of the updates for the MAPS portfolios. So right now we will have Q&A. So I see that many of you have already submitted your questions. So Dechun and I we will be helping to answer some of these questions. Yeah, let me just tackle the first question that is submitted on the UAE's departure from OPEC. So this is perhaps one of the biggest news that has taken place over the past 24 hours. So one of the members of the audience have asked, so what is the immediate mid as well as the long-term implications to markets because of this development? Okay, so let me start with the immediate implications for the oil markets. Okay, the departure of the UAE from OPEC will not have any immediate implications because why? The Strait of Hormuz is closed. So it doesn't matter whether the UAE now has the flexibility to pump more oil or not. Okay, because if they can't get the oil out of the Strait of Hormuz, they will not be able to influence the oil markets. They will not be able to influence oil prices. So in the immediate term, I don't think there's going to be a major impact on oil prices. Okay, so the in the intermediate term, okay, so assuming that the war draws to a close and the Strait of Hormuz starts to open. Okay, so what is going to happen then is the UAE now has the flexibility to pump more oil. So they are no longer subjected to the production quotas that were being imposed on them when they were with OPEC. So now they are no longer part of the OPEC. They're able to pump more oil. So when there is more supply in the oil market, what it does is it puts downward pressure on oil prices. So we could have a situation where, oil prices after the Strait of Hormuz reopens, the normalization of oil prices could take perhaps faster than expected. But having said that, I don't think that's going to change the inflation outlook. Even if we have a case where oil prices come down, the inflation outlook, I think it still remains unchanged because oil prices are not the only thing that is contributing to, the high inflation that we're seeing right now. Okay, it's not just crude oil. It is also about the refined petroleum products, the jet fuel shortages that we are seeing across the world right now. Okay, there is a chronic shortage of jet fuel. Okay, food prices are also going to skyrocket. Okay, because of the shortages in fertilizers. Okay, so that's going to also transmit into higher inflation as well. So even if we see oil prices coming down, I don't think that necessarily translates into lower inflation that will lead us to go back into rate cutting mode again. Okay, so the inflation scenario that I talked about in my presentation today, I don't think it changes, even if oil prices were to, come down. Hey, but again, another development that will happen after the war is that Iran is likely going to exert control over the Strait of Hormuz. They are even considering, implementing a toll, to transit the Strait of Hormuz. So this is a permanent increase in the cost of transporting goods inside and out of the Strait of Hormuz. So I think this is a geopolitical premium that will likely be priced in, which also means that when oil prices come down, it will still remain above the pre-war levels. Okay, so that's in the the intermediate term. But of course, in the longer term, I think it's a bit difficult to predict what's going to happen. But I think the likely outcome of UAE's departure from OPEC is that oil prices are likely going to be a lot more volatile. Because if you think about the role of OPEC, what is OPEC supposed to do? Okay, OPEC is there to help stabilize oil prices. So when oil prices go down, if it's too low, then what OPEC does is they will have they will have production quotas. They will stop producing so much oil to try to bring prices up. Okay, and when prices go up, then they will start producing more. Okay, so they are there as a stabilization force in global oil markets. So without UAE, and UAE is I believe is the second most important member within the OPEC after Saudi Arabia. So with the departure of UAE, what that also means is that OPEC is now in a weaker position, or rather, it is now less able to influence oil prices like it once did. So when you don't have that kind of influencing power, you will not be able to influence oil prices in the direction that you want it to be. So the result, the outcome of that is going to be volatile prices. Okay, so that's going to be the new reality that we are heading into with the departure of the UAE.
Okay, maybe let me take a couple of MAPS questions first. We'll let Raven catch his breath. So yeah, there's a question on how often MAPS is rebalanced, monthly or event triggered. Is today's rebalancing routine or event triggered? When will it do? When will we know when it's done to buy MAPS? Okay, so many questions here. So first of all, the rebalancing was done actually in early April, second week of April to be exact. MAPS is rebalanced on an ad hoc basis. Okay, so we don't have a set quarterly rebalancing. That being said, we monitor our portfolios closely every day. Should the allocations deviate from our intended allocations, we will trigger a rebalancing. So other times it could be event driven. So we think that so for instance, the recent conflict between US and Iran has really thrown things out of control, especially in the interest rate space, inflation, and some of the markets. So we would conduct a rebalancing to ensure that our portfolios are in line with our house view. Yeah, when will we know if it's done so that we can buy MAP? So typically when we conduct a rebalancing, we will send out a trade notice. There will be a notification that will be sent to your app also. Typically, rebalancing takes around 7 to 10 days. Yeah. When it's done, you will also receive a notification so you know when it's done, and then you can continue to RSP or lump sum should you wish to do so. Okay, maybe I'll take another question first. So for the digital economy under asset allocation, what are you referring to specifically? So for the digital economy here at iFast, we actually define it as a combination of two segments, internet companies and semiconductors. So these two segments, in our opinion, make up the entire digital economy. So that is also the allocation that you can see inside our MAPS portfolios. So we do have exposure to internet companies or big tech companies, especially those in the US, some of them in China as well. And the other significant part of our digital economy allocation is to semiconductors, which was previously represented only by the VanEck Semiconductor ETF. But after 2 weeks ago, it is now represented by both the VanEck Semiconductor ETF and also the Global X Asia Semiconductor ETF for the reasons I mentioned in my presentation earlier.
Okay, there is one question on Chinese internet and EV stocks. Okay, so let me take that question. So I didn't mention Chinese internet, but this is one of the sectors that we are actually quite positive on. So I mentioned AI. Okay, so Chinese internet companies, they have been implementing AI into their business models. Okay, so if you are talking about the likes of Alibaba, Tencent, okay, these are the companies that are actually benefiting from the adoption of AI. Okay, China may be behind the US in terms of making the frontier models, but in terms of the diffusion of AI across the entire economy, China is actually way ahead of the US, and they are doing it very well. Okay, you just need to look at the phenomenon of the open claw phenomenon. Okay, it wasn't developed by a Chinese company, but the diffusion of open claw across China has been widespread. Okay, so when it comes to the diffusion of AI across the economy, that results in the efficiency being transmitted across the economy, I think China is very good at that. And like I said, also in the global AI race, China has the cost advantage, which also means that these technology companies in China, they are going to be big beneficiaries as well. Uh, Internet and clean energy, I think there may not be a very close connection, but if you think about the clean energy thesis that I talked about just now, what is going to happen is that in China, you're likely going to see a revival in their manufacturing. Okay, right now, the clean energy sector, they are settled by excess capacity. They have overproduction over the years, and they find it very difficult to sell everything. But now that there is demand for all these products, there is going to be a turnaround in China's some parts of China's manufacturing sector, and this is going to benefit the wider Chinese economy and the big tech companies within China. They are also very sensitive to the macroeconomic conditions within China as well. So if there's going to be a recovery in the Chinese economy, it is also going to benefit the internet sector as well. Okay, so our recommendation, the ETF that I highlighted just now, the iShares Hang Seng Tech ETF, I think that is something that you can consider for your portfolios. But if you want to stick to SGX ETFs, we also have a Hang Seng Tech ETF on SGX as well. For EV stocks, I think it's a bit more. I think there are differentiations to it. You need to be a bit more selective when it comes to investing in China's EV companies, because you need to look at, which part of the supply chain that you're looking at. So if you're looking at companies like BYD, if you have seen their latest earnings results, their profits have actually dropped very substantially. And the reason for that is because competition is very tough. It's very fierce in the EV industry, and that has led some of these EV companies to start cutting their prices. So they've been sacrificing their profit margins. So if you would like to invest in EV stocks or just clean energy stocks in general, I believe the best way for you to get exposure to this theme is via a clean energy ETF. So when you do a clean energy ETF, EV will be part of the themes that you'll be investing in, on top of others such as your battery, storage technologies, the solar panels, all these in one ETF. So you get diversification. You are not exposed to any single company risk, which is very real in China, given the extent of the competition. Okay, I see there's also one question on the Asia semiconductors. Okay, as already shot up to a 52-week high. Maybe Terjun can also chip in with his views later. But I think for what I've shared just now from my presentation, yes, I think this is a legitimate concern. Okay, when something is up to 52-week high, I think the natural response from investors is that, is it too expensive? Should we wait for a correction? So one thing that I'd like to firstly point out is that, when we recommended Asia Semiconductor ETF, okay, we are also well aware that, semiconductor, it tends to come with much higher volatility, which is why if you want to invest in this sector, we think RSP is the best way to do it. Okay, so that's number one. Okay, number two, is there still upside potential? Yes, definitely. Okay, although there is going to be, greater volatility along the way, there is going to be a likelihood of a correction. Okay, there's going to be a likelihood of correction. But does that mean you don't invest in it altogether? Actually, that's not true. Okay, because if you look at Asia semiconductors, okay, they are just playing catching up. They're playing catch up to the US semiconductor companies right now. At the start of this AI story, the companies that actually rallied first are actually your US semiconductor companies. Nobody actually looked at Samsung. Nobody looked at SK Hynix. Nobody looked at TSMC. What were some of the companies that people were investing in? People talked about NVIDIA. So these were the companies that investors flocked into at the start of this AI story. And now they are only realizing that, actually TSMC, SK Hynix, Samsung, they are actually good companies to invest in as well. And they are now starting to, buy into these companies. And if you look at some of the earnings results, okay, SK Hynix and Samsung, for example, okay, they have already confirmed that their capacity is sold out for 2026. Okay, that's how strong the demand is. And the shortages are expected to persist until 2030. So this is not a trend that lasts for only a couple of months. This is a multi-year trend. Okay, the hyperscalers, they've already committed their spending. They will be spending, and that also means that the primary beneficiaries will be the Asia semiconductor companies. So instead of buying your US semiconductor companies, which are also very high and also likely to subject to corrections, what you can do is to buy into Asia semiconductors, which also benefit from AI, but they are cheaper. When the valuations are lower, it also means that if there is going to be an industry-wide correction, they will fall a lot less compared to your US semiconductor companies.
Okay, yeah, I think Wei Ren has brought up very valid points. I'll just supplement with a couple of my own. So first point is things that are at 52-week highs doesn't mean they cannot go higher. What matters is they are able to live up to their earnings expectations. So right now, I think most of the companies, especially the large ones inside these ETFs, uh, I think their prospects are really good. Demand is surging, capacity is constrained, prices are rising. I think this outlook is going to be sustained for at least for the next couple of years, which would give them the kind of earnings growth that would sustain such high valuations or perhaps push share prices even higher. And another thing about Asian semiconductors or rather semiconductors in general is this industry, it is highly competitive. The barriers to entry are extremely high. There are no viable replacements to many of these companies. So TSMC, for instance, it is the go-to chip maker in the world. If you want to make high-end chips, there is only one foundry that is a pure play foundry that is capable of making such chips for you. And for right now, TSMC is already at 2 nanometers and they're developing the next generation technology very soon. For the memory makers, SK Hynix is currently developing HBM4, which is the next generation HBM memory chips. I think Samsung and Samsung and Micron, they are also highly competitive in this space. But that being said, given the kind of demand that we are seeing in from the hyperscalers, I think these three companies, they are really struggling to catch up. So yes, valuations are high, but as long as these companies can continue to deliver on earnings, deliver massive earnings growth, I think valuations are still justified and share prices, they are likely to go higher. Yeah, and also on that point, I think our analyst is also writing an update on this ETF, so you can check out that article for more information on the Global X Asia Semiconductor ETF.
Okay, and that is the last question we will take for tonight. So thank you once again, Aaron and Tajin, for the wonderful sharing tonight. I'm sure we have all have learned a thing or two. And also a big thank you to everyone here who is with us this evening. We hope that you find the sharing useful in your investment journey in 2026 and beyond. And of course, we would like to give a shout out to our social channels. Finally, we would like to invite everyone here to connect with us. So on the screen here, you can see the links to our various social channels. Feel free to scan the QR code of the channels that you use often, and we will see you there. So we also like to encourage everyone to subscribe to our Telegram channel, whereby we post updates on the daily basis to help you in your investment journey. So with that, the webinar has ended, and have a great evening, everybody. Feel free to leave the room from now onwards. Once again, thank you very much.